If you're a Canadian trying to determine what's going to happen in the fixed mortgage rate market so that you can pick the best rate for you, I'm here to tell you that you could be looking at the wrong charts. In this video, I'm going to show you the actual chart you need to be following so that you don't lock into the wrong fixed rate mortgage and simply overpay for the next 5 years of your mortgage term. So here's the thing. The average Canadian consumer and most mortgage pros, bankers follow the simple trend of the 5-year bond yield. And that's not wrong in any way, shape, or form, but there is a better way to actually follow the marketplace. You see, the 5-year Canada bond yield, traditionally speaking, has been the #1 indicator of what's going to happen in fixed rate mortgages. Why this isn't always the best way to do it is because this is a lagging and or a false indicator, which means what you see in the bond yield market can actually take weeks and months to turn into mortgage rate changes. But if you want to know the actual tool that the banks use to make these decisions, which means real-time decisions and literally understanding within a week of when a bank's going to make a move, you want to be following something called the 4-year swap rate. And if you look at this article, this will show you a quick synopsis of what the 4-year swap rate is and how closely it compares to fixed rate mortgages in Canada. Banks themselves borrow money at variable interest rates, and then they lend it out to you at a fixed rate. So what happens is this actually exposes you to risk. So in order to protect themselves, banks use interest rate swaps. Basically, they pay for fixed and they receive floating. The cost of that swap is the real cost of offering a fixed rate mortgage. And that is why fixed rate mortgages typically follow the swaps versus the bond yields. So here's some information that you would need to know. First of all, the typical Canadian mortgage term lasts between 3.8 to 4.2 years. That makes the 4-year swap yield better for pricing than, let's say, a 3-year or a 5-year term. Bond yields are public, and so it makes it easy for the average person to follow and track it. The problem is it lacks current market signals as to what's going on. Swap rates themselves, they price in a few key things. It tracks liquidity, market demand, and risk premiums. And the thing is, bonds and swaps usually track together, but not always. For an example, in 2023, the bonds and the swap market actually moved apart by 0.25%, which means a lot of the market completely missed out because of that premium. So here's how you can use this to your benefit. And keep in mind, this might not be something that you want to follow daily, but I do. Swap spikes are basically a signal. When this happens, mortgage rates typically change within 3 to 5 business days of this move. If you see a jump in this actual swap spike, then it's a good time for you to lock in. Conversely, if you see it drop, then it could be the perfect time to renegotiate those terms. So here's a quick guideline. If they go up by 0.15% or 15 basis points, it is the time that you want to act really fast because there's a chance rates will go up. If we go down by at least 0.1%, you should be watching to renegotiate or seeing where the market goes down. And if the market goes up or down by about 0.5 basis points, then you just wait and see, because that means there's no significant moves coming. So what exactly do we do on our team to be able to monitor this for you? We watch the swap rates daily. And while we're not a lender, it gives us a good indication and clear signals as to where the rate market is going. This basically helps our clients to overpay based on the markets and waiting for the headlines, which could literally be weeks later. Now, this might get a little bit more complex, but when we're looking at this, we look at things like CMBs, the credit spreads, and what's happening in the market sentiment. And again, we're not pricing the loans, but this is what we're looking for. So basically, if you're serious about a mortgage strategy and trying to understand where this market's going, then this is how we follow the market on our behalf for our clients. The thing is, mortgage rates, they're not random. There is a predictability and a sequence to when their rates will change. Certain lenders have different premiums based on the product that you're offering, no different than a vehicle that you're buying in the marketplace, but they do move in concert with these swap rates. And the data point that you're looking for, as I mentioned, is that 4-year swap point. If you're trying to track all of this, but you're actually trying to figure out your monthly mortgage payment, click in the description below for our free mortgage calculator that shows you comparisons, how to analyze the marketplace, how much you can borrow, closing costs, and so much more. And if you found this useful, hit that subscribe button, and I'll see you on the next one.